investing in the future of fintech, Web3, and beyond. I'll be guiding the conversation. I'm Frank Chaparro, editor-at-large at news and research firm The Block. And we have folks joining us from across fintech and crypto investing. We'll start with Arjun. If you want to introduce yourself, and then we can go down the line.
Sure. So my name is Arjun. I'm the co-founder and CEO of Tribe Capital, about $1.5 billion in AUM. We do it across early, mid, and late stage venture equities and early, mid, and late stage tokens. The crypto's been a smaller portion of our portfolio for tokens, but we've been in picks and shovel businesses for a while. We're generalists, but we've lent more fintech over the last 3 to 4 years.
Great. Scott Sobel. I'm the co-founder of Valor Capital Group, and before I jump into my background, I just want to thank Frank for moderating this and Salt for having me participate. Valor Capital Group is a cross-border venture fund focused on US, Brazil, and Latin American opportunities. The firm has about $2.5 billion under AUM across 6 different funds now, early and growth stage. We have a dedicated crypto vehicle. We've been investing in crypto since 2014. And yeah, that's a quick background on myself.
Hi, everyone. My name is Vanessa Grellet. I'm the managing partner at Aglaé Ventures, which is a early stage VC fund focused solely on crypto and Web3. Prior to that, I was one of the first employees at Consensus and worked about 15 years in financial services.
All right, I'm last, I guess. Meltem Demirors. I'm a little bit of a unique creature because we are not a venture fund. CoinShares is a publicly listed financial services firm. We operate in asset management space. We have both crypto-backed ETPs as well as equities ETFs that track crypto companies that are publicly listed. We have a trading and capital markets business. We build capital markets strategies. We have a consumer finance business that is focused on the European market. And then we also invest through a variety of different vehicles. I focus on the investing side, but some of what we do is think about how we integrate all of the exciting things happening in the fintech space, the broader crypto ecosystem, into an actual functioning financial services firm that builds both products and services for a variety of investors, from large institutions all the way to individual retail investors.
Thanks, Meltem. Appreciate that. Last but not least, well, 2021 kind of saw the breakneck rise in valuations across public equities, venture stage firms, as well as crypto, Bitcoin going to 69,000. And then kind of 2022 saw the reversal of that. Where are valuations right now? Are things less rich than they were? And how are you making opportunities or making decisions in fintech and crypto?
You want to take it first?
Yeah, I think it's clear we've seen a reset, and I think it's a healthy reset. I think valuations got way ahead of where they should be, and multiples needed to compress. It's clear. And I think that's on a global basis. You know, we focus primarily in Brazil and Latin America, and I always say there's a little bit of a discount to valuations there, but they did get ahead of themselves as well. And I think through this reset, what I'm calling it, it's been healthy. Valuations have come back to where they should be, and more reasonable multiples. We're a generalist fund. Our highest concentration is in fintech, and if you think about the market that we invest in, it's been very concentrated. At least, speaking about Brazil, several banks and kind of the oligopolies kind of ran the market, and there was a lot of opportunity given the progressive nature of the central bank, the deregulation, the open banking that has occurred to open up that banking sector, and so as a result of that, a lot of capital came into the fintech sector. But if you also still think about it, if you take all the fintechs together and aggregate them in Brazil, they still make up less than 15% of Itaú, is the largest private bank in the region's market share. So it made a lot of sense that the capital came in to that sector. There's a lot of disruption ahead in that sector, and as just a result of that, the valuations, had gone up significantly. But again, back to your question and my point, I think this reset is very, very healthy, and it's, I think a lot of companies will get weeded out of it, and there'll be a flight to quality, and will be really good for the markets.
Yeah. Vanessa, maybe looking specifically at the crypto seed side of the market, we were seeing deals at the seed, pre-seed, with a valuation of 50 million, 45 million. There were some going for 100 million, if you can believe it. Nice
There were
work.
also uncapped notes that I saw for seed rounds, which was
It was outrageous. Have we reached normalcy yet?
I don't think so. I think we still see some overvalued deals at the early stage, but also later stage. And I think, given the global macro situation in the next 2 years, we'll see a leg down and people coming back to reality. I think right now a lot of VCs have a lot of money and raised a lot of money, so they need to deploy. And so there's still that pressure to deploy on these early stage deals, which provide great returns. We also see a lot of secondaries that are more moderately priced and more interesting now, of the companies that raised quickly before everything collapsed. But our perspective there is there's going to be downward pressure in the next 2 years still, and we haven't seen the bottom.
We've seen some of this we've seen this narrative unwind in the M&A market as well, right? With once darlings of the fintech world being cast aside. I'm thinking of Wire's deal with Bolt. I'm thinking of UBS's deal with Wealthfront. What do those sort of M&A deals falling apart mean for fintech investing, the fintech landscape, and you as an investor?
Yeah, I take a step back to your last question, is that if you take a look at whenever we had a boom or bust, you have a very slow ramp of sort of risk-on attitude. So it takes 1 and 3 and then 5 years. So you see this nice little linear ramp. And then the moment you have a bust, you have this massive dip and everyone gets scared and they sort of think about retrenching. And then you decide how much you're going to retrench. And so in 1999, 2000, 2001, I think there was 2007, 2008, and then even 2014, 2015, when LinkedIn lost 50% of their market cap because of guidance, you had this retrenching going on. So you have these cycles that continue and continue depending on what it is. So if you go far enough back, the main sort of educational, I think, change that's happened is how does software proliferate within certain industries. And we've been talking about fintech now, but it's still essentially you're building software in order to enable and underwrite risk at a healthier rate. So you still want to see margin, you still want to see spreads, just like any financial services company. And then if you take a look at the worldwide GDP, 50 to 60% of worldwide GDP is financial services or fintech, if you want to call it that. So what does that mean? It really comes back down to how do you think about intrinsic versus options value, and how are we valuing it depending on all the folks that are entering a different market. So we talk about crypto, we talk about fintech. They're all kind of correlated with each other depending on what you're building. And I always find it kind of challenging to talk about crypto. It's like talking about like the greenback or the US dollar or currency market. And then in an early stage venture, what you see is like early stage is actually quite price efficient. And late stage is quite price efficient. The reason why that's the case is that you have a lot of people here and you have a lot of people here because the value of how you underwrite the asset is very simple, right? You've got a ton of financials. You're looking at cash efficiency and growth at the late stage. At the early stage, it's like person with a PowerPoint and a deck, and you have all of this gradients in the middle of around what type of investor you are and how you allocate to the capital market. So when I think about Wire deal, we're on the board of Bolt, is that you're seeing companies like us and other fintech darlings or ones that are cash efficient or have revenue basically retrenching and saying, hey, we know there's going to be some sort of recalibration. I don't like the word using reset because it's not, right? If you take a 5-year average, have we reset from there? The answer is no. We've just been sort of oscillating over the last 2 years. And so when you take a look at it, it's like, what's your core business? How are you thinking about what works? How do you stay efficient? How do you continue to think about yourself intrinsically? And then what are going to be the options value areas that you need to invest in terms of human and financial capital? And that's kind of how we think about the world and the point of view and how we think and sort of guide. And so you can take a look at Square, you can take a look at Affirm. Are those businesses fundamentally any better or worse? It's not for me to say, but I would, if I take a look at Square, are gross transactions up? Yes. Is retention up? Yes. Are the cohorts and the strength of that business up? Yes. Are the margins gotten a little bit better here and there? But it depends on the quarter. And so how do you think about that company over a 3, 5, and 10-year horizon? And I think that's just no different than crypto or fintech, Web3, however people define these things. It's more of a surface vanity versus like the core of what the company does.
Mm-hmm. Do you think coming at it from a more broad perspective, what should the breakdown be for someone who maybe is taking a look at all of fintech and crypto, not just one or the other? Should it be 30% fintech, 30% crypto? What's the breakdown?
Well, I think when you do, again, we're biased because we're a much more concentrated firm, is that when you focus on like a quota, then you're going to sort of regress to the mean and have an index. And that's going to be sort of susceptible to market cyclicality. I don't like that. That's not how we think. And to a certain extent, when you build a company, you're also building a company to be enduring and sort of withstand market cyclicality. So you have to think about that as a portfolio management. It's not just portfolio management; it's also risk management around what's going to happen and how do you value your assets at the entry and exit point. So when you sort of think through it, where do you want to spend your time? It's essentially what are sort of index de-risked, what is sort of alpha orientation that you can get. And typically, everyone starts focusing on what alpha could be, but then you have these booms and busts, and you have these sort of FOMO cycles where you'll hear someone who's made like a 50 or 100 or 1,000x because they were an early stage investor, so everyone rushes in that direction. Mm-hmm. And then the next one will be like, hey, I did an early stage token, and so it could have been Terra, or it could have been Frax, and I've seen my net worth basically go down 500%, and then, a negative 500% up another 12x. And so you have to sort of be okay with that volatility depending on that entry point price that you're taking. But then what that means is there's not as much capital that can go into that stage.
Yeah. Meltem, you've been investing in crypto since 2013, so you've seen a lot of the cycles in that market play out time and time again. I feel like DeFi has lost mind share. How do you play in DeFi right now?
Yeah, that's a great topic. So I think when we look at the DeFi space, it was historically, and when I say historically, like 3 years, because this is crypto and timescales are compressed. I realized to a lot of people 3 years may not feel like a lot of history. But initially when DeFi started through this phase we called DeFi summer in the crypto space, a lot of the enthusiasm around DeFi was focused on these governance tokens. And I think, Arjun, you alluded to some of the challenges around valuing tokens, investing in tokens, and how venture investors interact with governance in general. And so a lot of the value went into these governance tokens, which for the large part have proven to be completely uncoupled from what the protocol itself does. A great example is Uniswap. Uniswap has a $7 billion token treasury in their DAO, or the autonomous organization that is supposed to steward and fund development of the protocol. And there's a lot of token value and token holders, but the voting process itself doesn't really make fundamental decisions about how the product develops. But despite the decline in the value of the token and the market cap of the token, the returns to the token, the protocol continues to be really widely utilized. And on most days today, Uniswap, which is a decentralized exchange, does more volume than Coinbase or Kraken or any of the other centralized exchanges. We're now kind of evolving to this new model, and we at CoinShares participate in the DeFi market through protocols like Maple Finance and others that are operating in sort of the regulated DeFi space, where you're operating with known counterparties. There may be a regulatory component or a compliance component where you're registering, who it is you're trading with. There may be a yield involved that has a native token, but largely it's basically taking a process that has historically been very manual and very process intensive and digitizing it and making it extremely efficient using these protocols. So we're seeing this migration towards taking existing models, whether it's syndicated lending, emerging market lending, on lending, which is marketplaces for other lenders to go and source capital at efficient rates, whether it's bilateral lending between institutions. We're seeing that just migrate to these protocols. They're not necessarily fully decentralized. The value doesn't necessarily come from the token, and we're seeing now a lot of projects asking themselves, what does it even make sense to make this tokenized? Is it important for this to be decentralized, or is the more important thing to build something, a service that is valuable to people, where people are willing to pay fees, where we can support a healthy and robust market and market growth, and then think later on about how to monetize that in the right way for investors. So we're seeing a lot more deal structures shifting from token-oriented to being equity-oriented, with a side letter that will say we may do a token at a future point, in which instance investors would be entitled to it. DeFi, not dead, still really exciting. In fact, one of the areas I'm most excited about, just shifting slightly because the retail DeFi market clearly has been challenged. And so I think the question is around suitability, what the right model is, and really for investors, where the returns are. And there's a lot of return in equity.
Yeah.
There really is.
I think you can summarize that as, in the DeFi boom or this most recent cycle, investors were not asking why token, but when token.
Yes, and what discount.
Yeah.
Which that's the job of an investor. It's to make returns. But I think the question is how to do that in a responsible and sustainable way that actually moves crypto forward, as opposed to some of the behavior we've seen that's been talked about at this conference a lot that maybe has been damaging or detrimental to mainstream adoption, as well as regulatory perception of what's happening in the space.
In a sense, a lot of what these platforms or protocols are doing is iterating on what we've seen in fintech maybe 5 years ago, right? Where you have Aave, kind of the comp there would be a lending club or lending tree. You have some of these more wealth management protocols that are basically a more automated robo-advisor. When you look towards the future, Scott, do you think that will the likes of Lending Tree or Lending Club, these, what we used to call or still call peer-to-peer platforms, are they competing against the Aaves of the world, or are the Aaves of the world going to eat the former's lunch?
Yeah, it's a really good question, and I think what we're all seeing is that fintech has become more of a horizontal and touches every industry, and crypto in the broad sense as well, and there's going to be a convergence that you're talking about, and it's hard to make fintech investments today where there's not on the roadmap some sense of moving it onto a blockchain and leveraging smart contracts, et cetera. And I can give you some examples of that, and it's pretty exciting. And I come back to the market that we're largely focused on in Brazil and the payment space in Brazil. Again, this was a very controlled, a small number of banks, a few merchant acquirers, payment processors there. And several years ago, a company by the name of Stone kind of came into the market and started disrupting it by simply providing better customer service. That was like just kind of a fintech play to a more kind of antiquated approach to servicing their customers. And that company did extremely well. They ended up from Brazil IPOing on the NASDAQ in 2018. And I think it was one of the largest fintech IPOs in history up to that point in time. And then shortly thereafter, there was another merchant acquirer that came onto the scene, and by the name of CloudWalk. And CloudWalk took a different approach. They built a better tech stack that was based on a blockchain, which they built themselves. And they acquired all their merchants, which are over 300,000 of them now, and they're acquiring over 20,000 a month through all digital channels. So, completely different approach. Now, what they're doing is doing DeFi lending off of their platform and the receivables, and doing phenomenally well. But that's the point of in your question of I don't think you can make a fintech investment with a company that does not think about the future and have some type of crypto blockchain element to what they're doing, because I think are the future rails.
Vanessa, do you also have to have an element of sort of metaverse or NFT-related assets if you're thinking about being some sort of fintech company, fintech platform? Do you need to be thinking about how do I help my client, how do I help my user store, custody my blockchain-based sword in the metaverse, or my bored ape, if you will?
So the emergence of NFTs has really produced a product market fit for crypto. And it's going, the NFT itself and the configuration of NFTs is not just for art, it's not just for pictures, it's for financial services, it's for specific financial products. And we're going to see the emergence of the representation of these assets through NFTs. There's already something called Uniswap v3, which positions is represented by an NFT. And the fact that it's a non-fungible asset, so unique digital representation of value, is something that we're going to see explode in the coming years in the financial services. So yes, there's that aspect that we see with art and NFTs and consumer engagement and a new sort of social media meme. But looking to the future, NFTs and the promise that they hold is really a digital representation of assets and the capabilities for us to transact globally and instantaneously in these assets. So we're very excited about that. We're looking at investments in lending platforms for NFTs, any sort of infrastructure which is going to foster that growth and that adoption.
So I can use my bored ape as collateral to buy a villa in Lugano, right, potentially.
Yes, there's already platforms that allow for peer-to-peer lending of NFTs, but we're looking at pooled assets of NFTs and collateralization and securitization of these assets.
But you're not bought into the idea of forging, really. The sort of the notion that you don't want to necessarily invest in the companies that are bridging the analog with the digital. You don't see a lot of upside in that.
So I think there's a really exciting space around the metaverse. So we're maybe diverging a little bit from fintech. And I think there's a lot of infrastructure that's being built in order to produce that experience of the metaverse, but the technology is not there. But the NFT technology and the blockchain technology allows for a unique thing, is the ownership in the digital world, the certainty of the ownership, which did not exist before. And so that's going to help us transition into these metaverse e-commerce, metaverse worlds where people can transact, own digital assets, and people are buying land in the NFTs. It's real dollars that are being spent there, and a lot of funds are really doubling down on this. And so think of 10, 20 years ahead, when all our children who are already totally in the digital world will continue to transact and interact in the metaverse, and have jobs created there and have real assets of value there.
Can I interject 1 second? I think one of the things that we do as entrepreneurs and technologists is make up a lot of shit around what will happen in like 10 or 20 years. Because when I was growing up in the 90s, and I might not look at it, but I saw the 1999 boom and bust, is that we would say things like, we're going to live in the digital world, the whole world is going to change. The reality is, no, it's not. It just gets augmented, and then we see things sort of progress in some areas very quickly, and in some areas very, very slow. There's a lot of folks here in this room, too, depending on what your age is, you're just not going to change that much stuff. And if you actually look at the global demographics and how people are interacting, in the Western countries, we're going to change a lot slower. And in the emerging markets, they're going to change a lot faster. And so when you think about crypto and blockchain and the rest of the things that are happening, what you're really looking at is just an evolution of software. And then we're adding liquidity, ownership, leverage, debt, because that's how the world works. And we're trying to figure out how that gets shifted, and how do we augment that to traditional business models. And so when we talk about NFT or DeFi or governance tokens, a lot of what you're seeing in the early phases of the industry right now is where does the value get accrued, and where do we make our investments, and then where do things get built. And so I think it's really important to think through those pieces when you're thinking about, as an asset allocator, where do you spend your time? As a builder, where do you spend your time? And why DeFi existed in the first place is that we need these rails in order for the software to continue to evolve. And so that, as a framework, I think those are really important. And so when you think about like DeFi, CeFi, decentralized exchanges, DEXs, these are all sort of on-ramps in order to provide this leverage and liquidity in some of these markets that are going to have a faster adoption rate.
So do you think that NFTs, as it pertains to the future of finance, is underrated or overrated?
It's probably underrated, and I can't think of all the use cases, but it's similar to how we think about, what a distributed database or a vertical integrated database, MySQL versus not, how are those all applied? Machine learning, like these words have been used and reused in different ways, and sometimes a negative or positive connotation. But like NFT, what does it allow you to do? It's okay, so you can have a unique asset into it. So that means I can put my house on it. Well, does that mean companies are going to adopt it like banks, and are we going to have mortgage-backed securities tomorrow? The answer is no. But could that happen in 5 years or 10 years? And will that happen here in the United States first, or will that happen in China or India or parts of Africa or Latin America? The answer is probably going to happen there first. And then we have to figure out what we adopt and we augment within our own regulatory regime, where we want to innovate, and what makes sense for our population and distribution, because distribution matters a lot. In the United States, our distribution of population is going to change how we adapt. And in India and Latin America, there's a distribution, there's a demand, and so that's why you see these products being built in a very specific way. So if you can do title and entitlement and insurance and ownership products in Latin America, where they've never had it before because they've never had brick and mortar retail, they're going to adopt it, and we may not need to immediately.
I actually want to bring it full circle, linking something Scott said and something Arjun said with what you questioned, what Vanessa commented on. So I think one of the important things we miss with NFTs and fintech, as Scott alluded to, I think every company in the world will be a financial services company. They just don't know it yet, or they don't have the tools to do it yet because the software isn't there. What we're doing with blockchains is just secure and credible, guaranteed financial computation. We're basically enabling anything and everything to become an asset. And so to me, the most exciting thing is the shift from institutions as financial sort of arbiters to influencers, being able to now monetize and become fintechs and financial powerhouses in their own right. It sounds crazy, but we look at Kim Kardashian starting a PE fund. We look at solo GPs who have built their funds through notable Twitter presences. We look at the rise of finfluencers. We look at the broader march of cultural capital into the world of financial capital. And I think there's a huge crossover that's happening that is really exciting, really scary, really profitable if you invest in the right places. And so I think there are all of these threads that sort of get woven together, which is what makes fintech, I think, such a large topic, because there's so many different verticals. But this trend of monetizing cultural capital, which is effectively what we're doing and have done for a long time, is not going anywhere. We're just finding that the mediums for doing that are effectively limitless as technology touches more and more of our lives. So I'm long this shift from institutions towards influencers, and I think it's going to happen actually more quickly than we might anticipate, particularly as this generational wealth transfer happens over the next 30 years.
You'll have to sign a check for Frank Bank then.
Yeah, I would be happy to invest in Frank Bank and Scott's lending service and whatever it may be that anyone comes up with. Sounds good.
We'll have to leave it there, but appreciate everyone for taking the time. And next year, hopefully, they'll give us maybe an hour, because there's just so much to unpack here.
Just scratch the surface.
Just scratch the surface, indeed.
Thanks for having us.
Thank you.
Thanks, Frank. Thanks.